This podcast episode is for investor education purposes only and is not intended to provide and should not be relied on for investment advice. Consult your personal investment advisor before engaging in any securities transaction.
On the other side of the world, and with monetary policies that are upside down from ours, Japan made some notable moves this week, and we'll look at that and some specific stocks on today's Wise Investor Show. Welcome to the Wise Investor Show podcast. I'm Chase Hinderstein. It's been another exciting week here where the market rallied around a Fed meeting, despite that meeting's conclusion being, I think, really largely telegraphed. But I'll circle back to that in a moment. And there has been some significant corporate results on the wire this week, and the markets are still pretty happy about their interpretation of all sorts of things because the three major indices continue to make all-time highs this week. In fact, I'm still getting a lot of questions along the lines of, how's this happening during a recession? Or why is the market doing so well when it looks like we're about to have a recession? Well, it looks like we're not really. You can choose to believe we are, but you'd be hard-pressed to find economic data points, ones that are generally accepted trailing or leading indicators, which are going to suggest that the economy is slowing down right now. Certainly not all perfect. It's far from it. But it really never is. So continue to be prudently cautious, especially when faced with assets that are priced at lofty valuations, but also beware the agenda of someone selling you conclusions that are just more aligned with their own agenda than with any real supporting data. Anecdotal information aside, as not everyone in this country, and surely not in this world, are doing great right now, but the conditions that move the economy as a whole are generally pretty good. So good, in fact, that the Fed is still fighting inflation that's sticky here around, maybe a little less than 3%. But despite their intent on hammering it down to a reading of 2%, they are also making it clear that they're ready to start cutting short-term rates. But before I get into that, let's look at another part of the world for a moment. This week, Japan, which is still the fourth largest economy in the world, pretty good for a nation of a little bit more than 100 million people. This week, they increased their interest rates for the first time in 17 years. And that's a big move for them. It's a country that's basically been more or less in recession, some years of a little bit of GDP growth, but really flat GDP growth to negative for decades now. But it's really a very unusual circumstance. It's not easy to study throughout this course of economic history to find similar situations like this, especially for some of the largest leading economies, whereby not only has their economy not shown any growth forever, but their population has also been in constant, basically, decline. And they hold net foreign assets, which is an important part of this equation. The country as a whole holds net foreign assets equal to more than $3 trillion, or somewhere over 400 trillion yen. And that's important as these dynamics change. What this means, and it's not going to sound good, but it has problems, but although the total economy is shrinking, or has been shrinking there, so is the nation from an economic point of view, such that they've actually been getting wealthier by some measures of this. And this matters at least to some investors because for 30 years or so, investors around the world have been able to borrow at really next to nothing costs in yen and use that cheap but otherwise stable, big economy, stable currency to invest those yen in dollar-denominated debt or invest it in euros. And you basically just make the spread, the differences in the interest, and it's kind of a free trade there. Now, as the U.S. and maybe the other G7 members are thinking about now lowering their interest rates, we'll see about Europe, but U.S. still definitely looks like we're going there, which in essence devalues the currency. When you lower your interest rates, currency gets weaker and vice versa. Well, Japan is changing course. It's ostensibly inflating the yen and upsetting a global balance and unwinding a lot of these big trades out there. Not last week, but what this course could mean over the next year or so. This is not a cause for alarm, but it's just an interesting flip in a long-term global balance. And it's worth watching, especially, I guess, because it means that the fourth largest economy with 100 million some odd relatively wealthy people are no longer going to be staving off deflation, which was the reason why Japan's policy had been this way for so long. But now they're going to let their monetary policy start tracking the data like ours tries to do. But they still have this aging, shrinking population. So deflation is what they may have to actually contend with next. And that's really the best thing we have going for us here now, which is a big looming problem, not just in Japan, but with China. It's that the U.S. actually has a lot of young folks. In fact, the U.S. has about a third of the total population below 24 years old right now. Yes, we have a lot of boomers that are retiring, and there's this tremendous wealth effect with those boomers retiring and ultimately to those folks moving on to a different realm, which is a whole nother topic. But our barbelled population, this big chunk of young folks coming into the workforce, plus the addition of more labor coming in, that's the best chance we have at long-term ultimately balancing our books, right? One of our biggest threats to our financial well-being and maybe our national security, this barbelled of older people aging out and having enough young people to back them up. But these other nations don't have that and are facing far bigger issues when you think about economics over the course of rolling decades. Speaking of which, the tendrils of Japan's shift in policy might actually be far more wide-reaching. And this was pointed out by a Financial Times article this week, in that many developing nations, the emerging market countries, they've been taking advantage of this yen policy, where for years now, they've been borrowing money denominated or taking out debt denominated in yen, referred to in that article as samurai bonds. They do this instead of borrowing in dollars because the dollar has this continued cycle of crushing debt because these countries' local currencies are always seemingly struggling against the dollar, but so much more as over these last few years, the U.S. was raising interest rates, the dollar got stronger and stronger, and the emerging market currencies went off a cliff in many cases. So they go out instead and they try to keep their wagon going by borrowing instead. They can't borrow in their local currency because no one will lend in it. They borrow in yen-denominated currency. But now that strategy might backfire if the U.S. does indeed enter this new pivot, this cycle of lowering rates, while Japan now reverses course and starts raising rates, leading to ultimately a rally in the yen and yet again backfiring on the third world's borrowing practices. Speaking of which, you've undoubtedly heard by now that while the Fed did nothing this week, the comments following their March meeting further propelled the market's momentum higher right now, as they seem to make it pretty clear that the Fed expects to cut interest rates 3 times this year by a total of about 0.75%. And while that's a lot lower than some of the forecasts from a few months ago, ones that had called for up to 8 cuts this year, it did at least ground the markets in its belief that we are heading in the direction of easing policy. And that's really what the Fed does. The Fed doesn't set mortgage rates. It doesn't set the 10-year benchmark treasury rate even. It sets the course. It sets what banks borrow at. It sets the course of interest rates. And by shifting the course, even if it's only, well, it's not even that modest, but even if it was 0.75%, it shifts the ultimate direction of where interest rates are expected to be going, from higher to trending lower. And the Fed officials indicated they expect the U.S. economy to grow by over 2% this year. And Powell said in his press conference, quote, "We continue to make good progress on bringing down inflation," end quote. That's where the markets really rejoiced. As of today's recording, the Dow's up about 6% for the year, the S&P's up 10%, and NASDAQ up over 9%, all making new highs this past week. And when I come back from a quick break, I'll tell you about a couple of specific stocks within those indexes. For the Wise Investor Show, this is Chase Hinderstein, and I'll be back in a moment.
Will the Magnificent Seven continue their spectacular run? Be careful relying too much on last year's playbook. Tune in every week to hear Simon Hamilton and Chase Hinderstein discuss the latest financial trends and what investors need to know. To learn more about some of the most important planning topics to consider and how to become a better informed, wise investor, listen to us at The Wise Investor Show at raymondjames.com/The Wise Investor Group, or just find us on your favorite podcast app.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.
Welcome back to the show. One company we've talked about for years here, it's one which I own personally. It's one we own in our clients' managed portfolios, and with that comes the conflict of interest caveat here, with me being positive about it on here. But then again, it's hard not to be positive when a company hosts an AI infrastructure analyst day. I mean, I say this partially tongue-in-cheek, right? It is a conflict of interest for me to hype a stock that I own. But if you're featuring a conference for all of the Wall Street analysts, what your key role as a company is in developing artificial intelligence, well, then you're turning some heads these days. And here today, I'm talking about Broadcom. Broadcom used to be thought of as this kind of sleepy semiconductor stock. It was cheap, paid a big dividend, and was somewhat reliable. It was really a proxy for Apple. Their primary business was supplying chips that went into the Apple phones, and they still have a role to play there, but that kept them at a pretty steep discount. They were under the threat of either Apple being in a down cycle, right, if it wasn't a year where they were going to sell a lot of phones, or the threat of Apple replacing them with their own chips. And Broadcom, both through their development and through acquisition, well, and you've heard me talk about this for many years, they started to diversify this business. They were really, for years there trading at this, at times, a single-digit earnings multiple, which were good. These were during good years where tech stocks were doing really well, but Broadcom at times was trading at below 10 times earnings. And actually in 2018 and 19, if you bought the stock at certain times, it was trading low enough that you were getting a dividend yield of over 5% on it at the time. But as they started this business development, they became important players first in the hardware side of what went into these big data centers. They were supplying these advanced chips that are needed to run the server farms that go in them. And then through acquisition, they brought Computer Associates. They then ventured into becoming more of a software as a service company, which brought reoccurring, predictable revenues. And with that, you expect to get higher valuation multiples. That was the story we've been telling for years. And at the time, the CA acquisition was supposed to be just kind of this big purchase of free cash flow that did not supposedly, wasn't expected to offer tremendous actual growth in its, where they were going to get additional revenue in that area. It was just kind of, you're buying someone else's free cash flow machine. But then the data center revolution really started to become more and more important there. Now, the stock has changed too. It's up about 150% just since the start of last year. It's up 21% in the first few months of this year. Broadcom is now trading at almost 30 times the forward forecast for the next 12 months or estimates, according to FactSet, with a price that now reflects a dividend yield of 1.5%, albeit with a dividend that's actually doubled since 2019, according to what I have here on my value line. So, if you had it from there, you bought it at 5%, and it's doubled, you can do the math. And now, Broadcom apparently is an AI player, and maybe not as sexy as the one or two stocks that you hear about every single hour on CNBC, but according to Goldman Sachs and their report on this event that Broadcom hosted this week, Broadcom's revenue mix from the chips that they sell that support AI programs are moving up from 25% of their chip revenue to now a new estimate of 35%, to a level estimated to be about $10 billion in revenue this year. Now, again, compare it back to, I'm picking this time that was before COVID and before a lot of this revolutionary stuff has happened. So I compare it back to 2019, total revenue then it was about $50 billion, according to this report. Now, they've been supplying chips, according to this Goldman report, for AI to Google and to Meta. And now they have announced they had signed an undisclosed third large customer. And this analyst said they believe that to be Microsoft. The report goes on to point out that Broadcom is benefiting from, quote, multiple waves of AI development, end quote, as their products plug into both the custom AI chips and also then they have the chips for the networking equipment that are needed to build out this large AI platforms that are really racing up now. However, one small twist to this succinct story, in the JP Morgan report that came out of this conference, which was still ostensibly pretty positive, but they speculated that this new big customer that was undisclosed could be ByteDance, which is the parent company of TikTok. And if you've been following the news lately, you'll know that not only is TikTok and their ongoing availability in the U.S. coming under fire, but also American companies, these semiconductors like Broadcom, are coming under additional restrictions from selling these advanced chips, especially the ones that facilitate artificial intelligence, to the Chinese. So the story does definitely have some risks, especially at these current valuations that I was pointing out earlier. And speaking of valuations, moving on, another company we've talked about on the show for years is Tractor Supply. This is the kind of semi-rural chain of stores that's a great place for either a small-time farmer or a big-time gardener to buy everything they could want. And I personally love going into these stores, and I've admired how management has led this company for years, going back before the great financial crisis, how they've navigated managing and continuously growing their store count, as well as how they manage their staff and maintain their staff during these various economic crises. But today we need to look at where the stock is trading at relative to the average analyst's expectations. This is another company that I personally own and which we own for our clients, so that same conflict of interest exists. But this is also a tale today of maybe that it's time to back off of a good thing. According to FactSet, today, Tractor Supply is trading at 26 times forward earnings estimates. And remember, this is a store where you buy dog food and weed whackers. It's not an AI stock. And that valuation is driven by the stock rising this past week to all-time highs and to a gain this calendar year of about 25%. Now, a good reflection of what I'm talking about is when you look at Goldman Sachs' take on the stock, which they have ranked as a buy, but which they have a target price on of $262 a share. That's a target where they think it'll reach over the next 12 months, or basically what that equates to is 2% lower than where it's trading today. Now, price targets aren't the be-all, end-all. In fact, price targets often can be a boost for the stock because historically these Wall Street guys just have a knee-jerk reaction. When a stock reaches their price target, the next thing they do is just jack up the price target, and Wall Street rejoices at that. But still, we need to be mindful that it is trading at the peak of its valuation range here. If I look it up on FactSet, I see that over the last 10 years, Tractor Supply peaks at about 26 times its forward earnings estimate, right about where they are today, and it troughs at about 18 times. Sure, the market overall has been very strong, but that same FactSet data shows that it's at its peak multiple relative to the S&P 500, which is an index that's heavily weighted and chock full of those hot tech and AI names. So this garden store is keeping up with the big boys there. Good company, and I'm okay to hang on to it if you're worried about taking gains or something like that. But in the least, it's not a name I'd be probably looking to add to here, and maybe one of which we should think about moving on from. And speaking of moving on, That's it for me this week. I do appreciate you tuning in. I'd appreciate it even more if you spent 30 seconds or so and clicked on like or wrote a quick review on your podcast app. For the Wise Investor Show, I'm Chase Hinderstein. Thanks for tuning in. Have a great week.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.